Welcome back. You're watching Markets at Noon, and it's time to talk about your portfolio. And today we have a very interesting guest. We have the co-founder of Bion Capital, Jigar Mistry. Jigar, hi, afternoon, and welcome to the show. This is Kavita Thapliyal. I'm also joined by my colleague Mansi Dave and Ankur Mishra, who will be asking you further questions. But then let's begin. And Jigar, let's start on a positive note. Okay, let's talk about the current domestic economy and market strength. So inflation is in check as far as it being under the comfort band of RBI is concerned. Rate cuts, further we are expecting more 25 pips, fiscal deficit and current account. Everything is in check for the for our economy and for our markets. What are you banking on, and how exciting are the next 6 months of this current year as far as the markets are concerned? What's your view?
Hi, Kavita. Good afternoon. Thank you as always for inviting me to your show. Yes, to put it in one line, India is sort of the macro darling in an otherwise sort of uncertain world. All the numbers you mentioned, the fiscal prudence with which the government has approached the central budget, the inflation data, the WPI data, everything else sort of seems to be checking perfectly fine. So it is not the macro that is troublesome, it's actually the internal construct with which sort of this seems to be moving. So if you look at the last few years, the central government, the state government, and PSU capex has driven the majority of the gross value addition in the GDP. And that construct now seems to be changing. So central government in their budget did sort of push through a lot in terms of lower taxes and giving money in the hands of end consumers. The state governments have been doing a lot more. So if you take sort of all the announced for the lack of a better word, let's call them freebies. So if you add up all the announced freebies, that budget is now totaling to almost the entire capex budgets of the states. And what they've provided in the state budgets is a much lower number. But despite that, the capex has slowed down from the states to a negative number. And central government has also pushed it out by 1 year. So there is more money in the hands of low income and middle income houses, and lesser money from the central government. And therefore, you are seeing the slight slowdown in the corporate earnings growth as well, which is filtering through the lower activity. So, as you also mentioned, great place to be macroeconomically, but it's the macro to micro switch that is a little confusing.
Agreed. Jigar, good afternoon. Mansi this side. What's your view on the earnings season? As we see, it's almost a week and more that the earnings season has started, the quarterly numbers, and started with the IT majors, which were a disappointment, mixed Q1 for the IT. And in particular, Infosys in comparison did a little better show, but otherwise TCS and other IT majors were, and even mid-cap IT at present is not really performing. But banks and financials, there were expectations right from the quarterly updates, and the numbers are also coming in those lines. Which sector, according to you, will be in focus for the quarterly earnings, and where will the support come in from?
Hi, Mansi. So if you sort of zoom out and see where the last quarter ended, and then that brings the current quarter into perspective. So last quarter, overall, there were more hits than misses. Hits and misses, we compare the consensus earnings to the total sort of actual numbers that came through. So overall, there were more hits than misses. But again, devil somehow is always in the detail. So the growth was driven by a lot of cyclicals. If you look at the larger weight components in the index, they were contributing negatively to growth. Whereas the cyclicals and turnaround stories, they typically have a lower weight in the index, and that contributed massively. Now, because of this, for the first time since COVID, you are seeing consensus cut their estimates into the Nifty companies. In the past 5 years or so, you have consistently had, at the start and end of the estimates, they were almost always aligned or a slight uptick, and that is resulting into some amount of cuts now. Coming on to the sectors, sort of where we see things playing out, IT remains a challenge for sort of the way we see this. Our belief is that essentially you're getting into an environment where the amount of new deal signs will be much lower. At the same time, the depreciation of rupee will be much lower. And when you combine these two, you will have pressure on the revenue as well as on margins. And it's not like, valuations are sort of steel cheap. They're relative to the history. They're cheaper relative to the market. But that's not how sort of IT acts, right? Because it's a global sector play. Where we do see sort of reasonably decent upsides in terms of earnings are pharmaceuticals, healthcare, specialty chemicals in some places, and obviously banking financials is one place which we are quite interested in.
Jigar, hi, Ankur this side. You mentioned about the sectors where one should invest, but there is an announcement which is expected in few hours about India UK FTA, and similarly the expectation is there about India US trade deal as well. How do you view this, and accordingly, how should one adjust in market? Which will be your sector specific bets as per these news flows?
Hi, Ankur. Just a very small clarification. I just communicated what we are interested in. I'm not trained or have the license to advise on people on where to invest. But I'm just relaying what we are doing that. On your question on where sort of the UK-India trade pact would take us, I think it's a very important step. Now, in a few areas, Bangladesh, Pakistan, and Vietnam, as I understand, where the MFN, the most favored nation status with Europe as well as UK, and that gave them a lot of access, especially in terms of cheaper exports into garmenting, textiles in general. And obviously, there is a counterplay on alcohol and beverages as far as India is concerned. So if the UK and Europe market opens up, which arguably is nearly as close to a market as US is, then it opens the gate for a lot of these businesses to do much better. And I would think it is a step in the right direction.
All right, Jigar, now the last question to you is now looking at this new trade world order, if we can call it. Any red flags that you think which can impact maybe in strategizing your portfolio in terms of sectors that you would not want to go ahead with? Maybe if you are overvalued over there, you might just want to cut down your weightages. As far as your portfolio management is concerned, maybe you want to just mitigate some kind of a risk. Anything on radar on those lines?
Yes, Kavita. So I think two or three things, one at the fat tail of the probabilistic curve and one much closer. Given sort of the rise in the retail participation, we are seeing some huge increases in, the number of shareholders for many businesses. We call them narrative stocks because the growth in the market capitalization has been much sharper compared to the growth in earnings for these businesses. And wherever you see those playing out, liquidity is a two-way sword. What comes easy goes away easy as well. And I think wherever you see a huge increase in market cap and not commensurate increase in earnings, and accompanied with a very large increase in number of shares, I think those are one business which we would sort of be a little wary about. Secondly, also look into this situation where there are very strong singular monopolistic businesses, right? Like liquidity, monopoly also works in very questionable fashion because what can be given with the stroke of a pen can be taken away, as you are seeing with one of the exchange companies today. That essentially you are having a situation where you saw this with the gas companies earlier, and now we are seeing the same with these businesses, essentially where the reduction in administered price gas took away the monopoly of these businesses. The exchange of power was dealt with a similar manner. Many of those businesses have a singular sort of party ordering, and those are trading at 50, 60 times. I would be worried of that. And the last part is, and maybe you can call this a fat tail philosophical line of thought. But historically, wherever there have been, revolutions, go back to agricultural revolution 10,000 BC or the Dutch, English, and French revolution 1600 to 1800s, there has always been an accompanied conflict with it. as AI takes over, I think that is one area where we should be a lot more prepared with several types of conflict. And therefore, wherever sort of you find a lot of excess is being built out, it behooves us to get a little more defensive along the way.
Quite interesting views coming from you, Jigar, and narrative stocks will remember that word. Thank you so much for joining with us and giving your views on the market. Have a nice day to you.